to do well over the next period too. This effect was big enough to let you make a little money, at least at the time of the study. Before you run off to implement this trading strategy, though, you need to know that any short or intermediate term momentum typically reverses over longer periods of about 3 years. Professor Werner de Bont of the University of Wisconsin and Richard Thaler of Cornell University conducted the study that's easiest for me to remember. You buy the 35 stocks that stunk it up the most over the last 5 years. Sell the 35 stocks that did the best over the last 5 years. Then hold that position for 3 years. De Bont and Thaler found that on average, the losers beat the winners by a total of about 25% over those 3 years. Think of this as a long-term reversal effect. If you decide that you want to chase a little bit of extra return by playing short-term momentum and long-term reversal, realize you have to make a rather dicey call on what's short-term and what's long-term. You might be able to make a little extra money relative to the market by playing this game with small, illiquid stocks. Small and illiquid stocks show this pattern more reliably than the rest of the market. These stocks are more expensive to trade, though, so it's not too surprising that many apparent profit opportunities that exist before trading costs aren't profitable once we factor in those costs. Another strategy that might earn a bit more than the market average is to buy what traders call value stocks. These are stocks with low market values compared to their accounting book values. Some studies have shown that these stocks tend to do a bit better than traditional risk measures predict. Yet another idea is to buy the stocks of companies that repurchase their own shares as soon as you learn that they plan to do it. There's some evidence that share repurchases foretell above-average returns. Buying stocks with low betas seems to be a reasonable plan too. Beta is a technical measure of how a company's stock price moves relative to the market. High beta stocks tend to move more than the market. Low beta stocks tend to move less. The average stock, by definition, has a beta of 1. The strategy of buying low beta stocks isn't designed to earn big returns. It's designed to earn bigger returns than you probably ought to earn given the low levels of risk you take. You can get estimates of stock betas from Value Line or Yahoo Finance or any of several other places. Warning, these estimates are notoriously inconsistent and unstable. That's both because there's no best way to estimate beta and also because there's some evidence that a stock's beta really does change over time. Following these strategies appears to produce returns that are slightly above what you might expect for the risks you take, or at least for the risks as we traditionally define them. Funny things tend to happen, though. Professor John Cochrane of the University of Chicago gives the example of value stocks, the ones with low market values compared to their accounting book values. You might think that you can add a lot of different value stocks to your portfolio and diversify the risk, but it turns out that value stocks tend to rise and fall together. You just can't get diversified if you hold a lot of value stocks. There's something about value stocks that gives them a tendency to move together. I think that's the reason for this. It's a risk factor that we don't understand yet. If value stocks carry more risk than traditional measures suggest, then it makes sense that you'd have higher expected returns than traditional measures suggest too. Professor Cochrane warns against chasing abnormal returns, at least not as your main portfolio goal. Instead, he recommends tailoring your portfolio so that it won't crater at the same time you lose your job, for example, or your business fails. That's exactly when you're going to need the money from your investments. If you work for Ford, then don't buy a lot of auto stocks. I'll leave you with one more thought before we switch topics. If you think you can improve your portfolio returns by shrewd trading, remember Lecture 6 and give some thought to how much you'll earn in dollars. Suppose that you spend an hour a day, just on weekdays, studying stocks. You build your trading strategy on what you learn. Suppose that you turn out to be a great trader. You beat the market by